Debt collection in America is a multi-billion-dollar industry, racking up just last year $13 to $14 billion. And there are roughly about 77 million Americans whose debts are past due, and are in an industry now that's built upon extracting money from these people in any way possible. For example, there was a couple profiled in an NPR piece recently that have, because of their debts, they're garnished $760 a month from each paycheck. That's wow, that's a lot of money. Now, this is for some of the debts, about $20,000 worth of medical debt. Now, medical debt is one of the biggest drivers of debt and bankruptcy here in America now these days, pretty close to student loans, which have, of course, surpassed pretty much everything, maybe other than credit card debt. And, of course, a laptop loan that the husband had taken out after high school, so he wanted to get a laptop. But it's not just garnishments that these companies can do. They can also go after your bank accounts. For example, the same family has had their bank accounts completely seized and emptied by debt collectors. And this happened at least twice to them. Now, this is legal, by the way. This is legal because because banks weren't addressed in a 1968 law called the Consumer Credit Protection Act. Now, that did put some limits on wage garnishment, but left bank accounts out. So what's the limit, by the way, when it comes to garnishment? Well, that limit is about 25% of your income. So yes, if you have a debt that's being garnished, they can take a quarter of your income. Unfortunately, the law also doesn't help people unless they're extremely poor. Well, how poor? Really poor. Because you see, when it was passed, it was tied to the minimum wage. The minimum wage back then, in 1968, was somewhere around, in our dollars today, about $10 an hour, $10.26, I believe. Now that minimum wage is about $7.25 an hour, you have to be extremely poor in order to be protected from garnishment. And how poor is that? Well, you have to make less than $217 a week. Now, what does that come up to? That's about $10,500 a year. Yes, $10,500 a year. If you are above that, sorry, you're going to get a quarter of that income garnished if you have an outstanding debt. And here in America, 77 million of us do have that outstanding debt. Not only that, but once again, they can scoop out your entire bank account. But it's not just money that can be seized and paychecks garnished, but they can also take your property. They can seize that to help pay for unpaid debt. Oh, look at that. You got a decent car? Let's just take that. Get a nice gift from a friend? It's ours now. This whole thing has the possibility of making you poorer than if you were making less than $10,500 to begin with. And need I mention the fact that prices for just necessities have risen a lot in the past 40, 50 years. And that just shows that Americans, these people who are the most vulnerable, are in for even more of a world of hurt.
You are supposed to pay your debts. You are supposed to pay your consumer debts. But there's one caveat to that, is that there is a responsibility in a free market system on the behalf of the borrower and the lender. The lender has to assess credit, and sometimes as a lender you lose money. Like, this seems like it was originally a consumer protection, and now it has become a lender protection. And anytime you have lender protections like we had in the housing market, like we have in the student loan market, of course now the federal government's a direct lender, you get excessive lending or lender-induced fraud. And I'm not saying that's particular to this case, but the other thing you get is a disincentive, as you disincentivize negotiating down the debt. Like, I've had family members that are in debt. I'm sure everybody has had family members that are in debt. 77 million Americans is not insignificant. And after a while, your creditors try and negotiate a settlement, and usually they knock off some of the interest. They ask for a lump sum, and like you guys can work it out like that. you'll take a hit on your credit, but like it's a fair exchange to stop the monthly payments and stuff like that. And a lot of people do enter into these debt settlements. This this being able to garnish 25% of somebody's wage totally disincentivizes that negotiation process, and like it's just you in a capitalist system you need to have incentives on both parties to have good behavior, not just the consumer. And I feel like this has been tilted by this regulation far too much toward the lender, and that it negatively impacts the market and the consumers.
Having a quarter of your income being taken when you're already low income, this primarily hits people who are between 25 and 40,000. That's where a lot of this debt factors into, and people in between that income bracket. So it does really impact people on the lower edge of the scale. The Walmart workers, the people who are working fast food, minimum wage, etc., families. And
by the way, just to clear something up, that 25% itself is misleading, because they calculate the percentage on your gross income, then they take your taxes out, and then they take 25% of your gross income out.
Which is even worse.
Yeah, it's more. It's of your take-home pay. It's significantly more.
Mm-hmm. And what goes along with that is the fact that these people have less and less money because more is being taken out, and also the prices of things have risen by such a large amount, especially since 1968. These rules are very outdated and they're very draconian, and they're very harmful for the economy and for people at large. I mean, if people, weren't getting that much garnished from them, or made a little bit more to be able to pay off those debts, that would allow more money to get back into the economy. And that would be a generally good thing. So these rules need updating badly.
Neither Jeff or I are saying that. I don't know about Jeff, but I'm pretty sure he'd agree with this. Are saying that people who borrow money should borrow irresponsibly. All we're saying is, or all I'm saying specifically, is that the lender should be incentivized to lend responsibly, and there should be, in case of situations where debt gets out of control, an incentive for both parties to come to the table and negotiate in good faith and on a semi-equal plane.
And let's not forget that this isn't just about people who borrow money. Like, there is a significant chunk that borrow money for things like student loans, which can't be discharged through bankruptcy. I understand that. Car loans, home loans, etc. There are a significant amount of people who fall under this from borrowing, debts that they couldn't repay. But then there are also the people that get into debt through no fault of their own. And that's where the medical debt comes into play. And that's what plagued this specific couple that were covered in the NPR story. And that's where a significant amount of people really fell into that kind of debt, is because they didn't have good insurance. Something major happened to them, cancer, sickness, surgery, etc., etc. I mean, all of that's bad enough on its own, the medical bills, and then not being able to work alongside of it, that can get you into crippling debt fast. So it's not just about people who are irresponsible with their borrowing. It is about things that happen to people and happen all the time through no fault of their own. So there's definitely a mixture of that, and I didn't want to let this segment go without making sure to remind everyone of that.